We're starting off with a look at Valero Energy, an integrated downstream energy company that's been making waves in the industry. The company recently released its second quarter earnings report, and the numbers are impressive. With a net cash provided by operating activities of $5.6 billion, Valero is showing no signs of slowing down. But what is driving this success? Let's take a closer look. Valero's renewable diesel segment posted an operating income of $717 million, compared to an operating loss of $79 million just a year ago. And its ethanol segment reported $318 million in operating income, up from $54 million last year. These numbers are certainly promising, but what do they mean for investors? To break it down, Valero's focus on refining crude oil into finished fuels like gasoline, diesel, and jet fuel is paying off. The company's also making significant investments in renewable fuels, including ethanol and biofuels. And with a logistics network that spans pipelines, terminals, rail, and marine assets, Valero is well positioned to move feedstocks and finished products efficiently. Of course, no investment comes without risks. Valero is facing uncertainty surrounding policy, particularly when it comes to renewable diesel capacity expansion. And the company's debt-to-capitalization ratio, while manageable, is still worth keeping an eye on. So what is the takeaway? Valero Energy's Q2 earnings report shows a company that's diversifying its portfolio and investing in the future of energy. While there are risks involved, the potential rewards are significant. As always, it's essential to do your own research and consider your own financial goals before making any investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story that's been making waves in the business world. A recent Supreme Court ruling has potentially opened the door for U.S. businesses to receive up to $175 billion in tariff refunds. This decision, which deemed President Donald Trump's broad tariffs imposed under the International Emergency Economic Powers Act as exceeding congressional authority, could have significant implications for import-heavy retailers. Companies like Walmart, Costco, and Target, who import billions of dollars worth of merchandise every year, could be among the biggest beneficiaries of this ruling. The refunds would effectively put money back on their balance sheets, potentially strengthening their free cash flow, improving profit margins, and creating value for shareholders. However, it's essential to note that not all retailers will benefit equally, as the refunds would only apply to tariffs collected under the program ruled unlawful. The timing of these potential refunds is also a crucial factor, with additional legal proceedings and appeals processes likely to delay payments. Nevertheless, the sheer size of the opportunity is undeniable, representing one of the largest potential cashback transfers to American businesses in years. As this story continues to unfold, it's crucial for investors and businesses alike to pay close attention to the developments and their potential impact on the market. It's also worth mentioning that Amazon and other e-commerce companies could be affected by these refunds, as they have been impacted by the tariffs on imported goods. Furthermore, the ruling could have broader implications for global trade and economic policies. As we continue to monitor this situation, we'll provide updates and analysis to help our listeners navigate the complexities of this issue. In conclusion, the Supreme Court's decision has created a potential tailwind for import-heavy retailers, but it's essential to approach this development with a nuanced perspective, considering both the opportunities and challenges that lie ahead. Welcome back to the Riskwiser Zone, folks. As we wrap up today's show, I'd like to dive into a fascinating tale of technological innovation and strategic maneuvering in the semiconductor industry. You see, Intel Corporation has been making waves lately, with its stock soaring by over 300% in the past year. But, as Jim Cramer astutely pointed out, Intel is more than just a computer chip manufacturer. It's a diversified player with a foundry business, packaging capabilities, and a growing presence in the AI space. Now, I know some of you might be thinking, Louis, what's the big deal about Intel? Isn't it just a legacy tech company trying to keep up with the times? Well, my friends, that's where things get interesting. With its foundry business and plans to expand its U.S. manufacturing footprint, Intel is betting big on the future of semiconductor production. And, as Kramer noted, the company has a passionate advocate in its CEO, Lip-Bu Tan, who seems to be steering the ship in the right direction. But, as with any investment story, there are also cautionary tales to be told. The bears are worried about Intel's high valuation multiples, its significant debt load, and the challenges of competing with other industry heavyweights. And let's not forget the concerns about the company's ability to secure major orders from firms like Apple and Nvidia to justify its investments in the foundry business. Now, I'm not here to take sides or make predictions about Intel's future prospects. My job is to provide you with a balanced view of the situation so you can make informed decisions about your own investment portfolio. And speaking of which, if you're interested in exploring other opportunities in the AI space, we've got some fascinating research on the cheapest AI stock with 100 times upside potential. But that's a story for another time. As we close out today's Riskwiser Zone, I want to leave you with a thought. In the world of tech investing, nothing is ever certain, and even the most promising companies can face unexpected challenges. So always remember to do your due diligence, stay informed, and never put all your eggs in one basket. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.